You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. Well, we took a week off to answer some listener questions, which is one of my favorite things to do. I always get to team up usually with Mark Wango of Options Insider, and we have a great time answering your questions. We're going to do a little bit of a rinse and repeat strategy. We talked about the long straddle. And we looked at, I think Mark actually coined it, a doppelganger long straddle in their airlines. Well, there's definitely been a lot of volatility in airlines, and that trade overall should have been a decent paper trade. We had the stock go down a little bit, but go up quite a bit. Both of the stocks that we were looking at 14 days ago, were LUV, Southwest Airlines, and UAL. We bought a put in UAL, and we bought a call in LUV. The only thing that was incorrect about the trade, if you look at where the markets are at and what's going on with them, is that we thought UAL would be a little bit more bearish because of their overseas exposure relative to LUV. It was just a paper trade. It was just for fun. Turns out that UAL and LUV went up quite a bit, and UAL actually went up more than LUV. So overall, that trade worked out, and it still could be living. We did the June 19th expiration. We paid $5 after hours. Markets, we taped it, Options Playbook Radio, after hours. And the midpoint pricing was $5, which would have been a little expensive. I looked at it in the morning. It went to quite as much. But it was $5, and the stocks have moved way more than $5 since that. It's mainly been to the upside. But the reason why I bring it up is that on the show, we definitely emphasize that if you're going to do this trade, don't be afraid of legging out of the trade. And that's why I wanted to bring that to your attention in that. For example, today, Southwest Airlines is trading at 37.14, which we did this trade, the underlying market. I just listened to the session of Options Playbook Radio, and the underlying market was at 33.66. So we're close to the 5 points. 5 points would be 38.66, but that stock has been much higher over the time frame. The highest point that it got to was just the other day on the 5th of June. We saw the high at 42.35. So if you didn't get out on the LUV call side, you really should have received the stupid award for it. with the stock up that much, you definitely would have got out at some point in time. The question is, did you get out after it was up $6 or after it was up $7 or $8? So now the thing that is interesting about it is everybody's kind of talking, or as the airlines were running, everybody was kind of saying, why are these stocks running up? And guess what? Today, the stocks now are running back down to the complete opposite direction. So if you did sell out your call, you would be long a put in UAL. And you could quite possibly profit on that position. Now, at the time, it was $30.69. Now, once again, this is a paper trade. We're just going over. And I said it would be fun to watch, and I was not. I'm not disappointed in what has happened, because it definitely was a fun trade to watch, and still is if you still are trading it on paper. But UAL overall is now currently trading. It made a bigger run up. It ran up on a percentage basis higher than LUV, but today it came down on a percentage basis more. It is down $5 today, $4.92 to be exact, or 11%, and it's trading at 39.17. Now, we did the June 23rd expiration, so if no, June 19th. I'm sorry, the 23rd is a Tuesday. The June 19th expiration. So you still have more than a week for that option contract to live. And you could obviously let it ride. It first of all, it's a paper trade. And on top of it, you've already should have been profitable on the trade. So it could be very interesting in that if this underlying actually gets down anywhere close to the 30 level where the underlying stock started at when we looked at that doppelganger long string straddle, you might be interested in just selling at that point. But I would pick a point and I would look to sell. I really don't want to ride it all the way to the end of the week. If there's any juice in it whatsoever, I just want to get out probably on Monday or Tuesday of next week. I'm not going to go all the way till that Friday. All right, so on this week's trade, it's going to be a little bit of a rinse and repeat situation in that we should be profitable if we did that long doppelganger straddle in the airlines, and we may still be long a put option in UAL. So we're going to go with the momentum to the downside that happened in the airlines today, and that actually was started by JP Morgan. They're the ones that downgraded all the airlines in general today, and that started the downward movement. So we're going to try to pile on with that by doing a long put spread. And the underlying that we're going to use is an ETF. I haven't talked about ETFs, but we're going to look at the ETF with the symbol JETS, JETS. And here's the reason why. Is I went out and I looked at 30-day implied volatility in all of the airlines, and rightfully so, it has spiked up recently. I look at UAL 30-day implied volatility, the weighted index that is inside the Ally Invest platform, and that's trading at 118% implied volatility. Then I ran over and I looked at American Airlines, and that's even higher. That's at 158% implied volatility. Now, if I go inside the Ally Invest platform and I look at the research for ETFs, it will show me the top 5 holdings in that ETF. And this ETF, symbol JETS, JETS, it shows me that the top 5 holdings are American, Southwest, Delta, and then United, and the last one is a lesser known Air Transportation Services Group. So those are the top 5 holdings. So it has these underlying stocks, but yet it's trading at a lesser implied volatility, which would make sense. It's trading at about 86% implied volatility on the same 30-day weighted average. So because of that, we're going to get short the airline industry by using JETS and doing a long put spread. And I'd rather be in a little bit lesser vol. 158% implied volatility is just quite high to even pay up in a long straddle scenario, because we're going to be a little bit more speculative. We're going to buy and at the money and sell and out of the money. So here's the paper trade for this week. We are going to go out 30 days in time. I'm going to go out to the July 10th expiration, a little bit longer out than I would normally do in a long call or long put spread. We're going to buy the 19 strike Jets put July 10th expiration and sell the 15 strike Jets put July 10th expiration. The stock closed at $18.92, down $1.54 on the day. So we're basically buying an at-the-money option contract and selling an out-of-the-money option contract. But that 15 strike put is still trading for 40 cents on the midpoint. So we're doing this entire trade for a net debit of $1.43 to the account. That's going to be our maximum risk. For every 1-by-1 spread that we do, that's $143. Don't forget to add the commissions. And once again, this is just meant to be a paper trade. So let's just follow this. This is a speculative area that we're trading in, but I would rather trade in a higher volatility environment than a lower volatility environment if I had my ruthers. The width of the spread is 4 points wide. So you take 4 minus $1.43, and that means our max upside is $2.57. So that would be $250 of less commission for every 1-by-1 spread that you put on. And our goal here is that underlying stock goes below 15 by that July 10th expiration. That's kind of what we'd be looking for. We're managing our risk a little bit. We have a decent risk-reward scenario. Now, there is a lot of implied volatility, so you're still paying up for it, considering that this is a $19 stock. We're still paying up for it. $143 overall, though, will be our maximum risk, and we have $2.57 worth of upside. So you can approach this on just an all-or-nothing trade. Either the stock goes down and I am profitable on it, or the stock goes up and I lose my $1.53. The risk-reward ratio is decent for both sides as far as managing the risk. I have, in this instance, about $1 more upside than I do on the downside. $2.57 of upside with $1.43 worth of downside. Now, you can always take the approach, and I guess it's really about how you want to think about your long spreads. A lot of people might say, well, if I'm down 50% on the long of my debit, in other words, I paid $1.43 for it. Let's say it's now trading for 70 cents or so to close it. Maybe I would get out of that trade then. I'd still let my winner run, but I would try to manage more of my risk on the downside. And that's up to you. But now here's one of the things that I always talk about here on Options Playbook Radio is if you make a plan, stick with it and try to keep that strategy going forward on how you're going to approach any of your speculative long spread positions. All right, so let's do one last summary. We are taping Options Playbook Radio. It is June 10th. The markets are closed. The underlying we're going to talk about is an ETF. The symbol is JETS. JETS is that symbol. The last trade on JETS today was 18.92. It was down $1.54. We're going to look at the July 10th expiration, which is 30 days out. We're going to buy the 19 strike put. We're going to sell the 15 strike put. We're going to do this for a net debit of $1.43 to the account. So that's $143 plus commission for every 1-by-1 spread that is put on. Our maximum upside would be the width of the spread, which is $4 minus $1.43 or $2.57. All right. Well, we'll come back next week and we'll see how this trade is doing, but it has some time to play out. And that's going to be it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.